Today, let's talk about a dividend aristocrat that knows how to make money in two separate industries, General Dynamics. Personally, when it comes to multitasking, I have enough trouble unitasking, but General Dynamics has had great success making both weapons of mass destruction and private jets for businesses. And GD stock has beaten the market decisively over the long term, while also having a healthy advantage over the last year. And the company has not only paid dividends for decades, it's also grown those dividends for decades. As a dividend growth investing guy and the manager of the Income Builder portfolio, that matters to me. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk more about this outstanding company, please do us a favor to help us grow our channel, okay? Hit the thumbs up at the bottom of the video, subscribe to the channel, and ring the bell so you get notifications of new videos as we publish them. Alright, now let's talk about General Dynamics' history, discuss its business model, get into how it might interest dividend growth investors, and talk about why I've selected it yet again for the IBP. In 1944, Canadair was created by the Canadian government to build military aircraft for World War II. 2 years later, controlling interest in Canadair was sold to Electric Boat Company, which launched ships such as the USS Barracuda. In 1952, General Dynamics was formed to become the parent of Electric Boat. The company made history in 1954 when it launched the world's first nuclear submarine, the USS Nautilus. For the next 40-plus years, General Dynamics built its business around making submarines, warships, fighter planes, missiles, and electronic systems for the U.S. military. In 1985, GD got into the private jet business, buying Cessna aircraft. In the early 1990s, the Pentagon spending flurry slowed some, and General Dynamics pared down its operations. It sold its Data Systems division in 1991, Cessna in 1992, the Fort Worth aircraft production business in 1993, and its space division in 1994. Later in the 1990s, though, GD was beefed up again with numerous acquisitions. Bath Iron Works, Computing Devices International, Lockheed Martin's Armament Systems and Defense Systems, Lucent's Advanced Technology Systems, and NASSCO Shipbuilding. In 1999, the company capped the shopping spree with its $5.9 billion acquisition of Gulfstream Aerospace, getting General Dynamics back into the private jet business that it had abandoned when it sold Cessna a few years earlier. In addition to building up the defense side of its operations, General Dynamics in 2008 acquired Swiss business service provider Jet Aviation. In 2013, former CIA operative and Pentagon official Phoebe Novakovic became GD's chairman and CEO. She's one of the few women executives in the military-industrial industry, and she regularly makes lists of most powerful women and most influential women. In 2018, General Dynamics made its largest acquisition ever, a $9.7 billion deal for information technology services giant CSRA. It integrated CSRA within its burgeoning GD-IT division, a leader in delivering technology to the military. In 2020, GD landed more than $10 billion in Pentagon contracts, saw its new G700 Gulfstream jet make its first flight, and began construction of its first Columbia-class ballistic missile submarine. Now let's talk about what General Dynamics has going on today. First, here's the way Morningstar Investment Research Center described how GD makes money. General Dynamics is about 3/4 defense prime contractor and 1/4 business jet manufacturer. Defense primes rely on defense spending for revenue, and we favor companies with tangible growth profiles through a steady stream of contract wins, ideally to contracts that are fulfilled over decades. General Dynamics' crown jewel of long-cycle contracts, the Columbia-class submarine, exemplifies this with planned procurement through 2042. Regulated margins, mature markets, customer-paid research and development, and long-term revenue visibility allow the defense primes to deliver a lot of cash to shareholders. General Dynamics' business jet segment is low volume, at roughly 200 global deliveries each year, and many repeat customers. Gulfstream dominates volume in this segment, with roughly 50% market share, which leads to superior margins." Close quote. During its most recent earnings presentation, on October 27th, the company's data showed it beat estimates for adjusted earnings, but revenue failed to meet analysts' consensus estimates in the aerospace, technologies, and combat systems segments, while barely beating expectations in marine systems. Supply chain delays and semiconductor shortages caused some of the revenue issues, especially in the technology division. Still, both earnings and operating margins were up in that division. Company-wide, earnings and revenue were up year over year and also quarter over quarter. The company did say that the relatively disappointing revenue gain would weigh on full-year sales figures. Mr. Market never likes seeing guidance lowered, and the stock price has declined slightly since then. But we're still talking about a company with a great all-around financial picture. Jefferson Research rates GD's balance sheet and earnings quality among the strongest of the stocks it analyzes, and General Dynamics has strong cash flow quality and operating efficiency too. In raising his price target on General Dynamics to $235 on December 1st, Cowen analyst Kai Van Rumer says he was especially bullish on Gulfstream. He told Yahoo Finance, quote, demand was essentially stagnant for a little over 10 years, and I think a couple things changed. COVID basically encouraged people to want the safety and convenience of not flying commercial air travel. And secondly, the number of high net worth individuals increased, so we've had a real pickup in demand. I'll get into more analyst forecasts and valuation information in a minute. First, let's talk about the dividends that GD sends to its shareholders. General Dynamics has been a consistent dividend grower. Every March, like clockwork, the company announces an increase in the 8% to 11% range. Though it appears the dividend growth is slowing a little, I'm actually pretty impressed with those 8% raises of the past couple years, given that there's been a global pandemic. General Dynamics is in a cyclical industry, especially its aerospace division, so its free cash flow has risen and fallen over the years, as the orange line on this fast graphed image shows. But as the white dividends line shows, free cash flow has easily covered the dividend year after year after year. GD's reliable, growing dividend helped it beat the S&P 500 index long term. In price growth alone, the index has fared slightly better over the last 15 or so years. But once dividends are factored in, General Dynamics' 9.46% annual rate of return beat the index. General Dynamics yields about 2.4%, and one thing I really like about its dividend is that investors can count on it. Simply Safe Dividends gives GD a score of 97 on its 1 to 100 scale. Put that together with the long growth streak that gives General Dynamics dividend aristocrat status, and you've got a company that's at the top of the heap among its defense contractor peers. That 97 score is only one of the many excellent quality-related ratings GD has received. It gets Value Line's top grades for financial strength and relative safety, Morningstar's Wide Moat designation for its competitive economic advantages, and a solid A- credit score from Standard & Poor's. Alright, now let's talk about how buyable General Dynamics stock is. 13 of the 20 analysts monitored by Refinitiv call the stock a strong buy or buy. The mean price target of those analysts is $228, suggesting about a 14% upside. In October, Morningstar raised its fair value estimate slightly to $191 and said that's within a range we consider fairly valued. Value Line likes GD's potential for generating capital gains long-term, with as much as 50% appreciation over the next 3 to 5 years. But its analysts actually believe shares could lose about 10% over the next 18 months. That bearish near-term forecast is not shared by CFRA, which calls General Dynamics a strong buy and has a 12-month price target suggesting a 21% return. CFRA analyst Colin Scarola explained his bullishness by saying, "Our strong buy reflects a positive long-term outlook due to GD's strong brands, high barriers to entry, a healthy environment for defense firms, and undervaluation. We think poor sentiment, not fundamentals, is driving GD's low valuation, with business travel commonly viewed as unlikely to recover from the pandemic and Democrats viewed as unfriendly to defense firms. We disagree with both, as U.S. business jets are flying 20% more at present versus pre-pandemic, and Senate Democrats already approved a 5% defense spending increase from the Trump-era level, not a cut." Other notable price targets from analytical firms include Zacks at $213, Argus at $2.25, Credit Suisse at $198, Wells Fargo at $230, Goldman Sachs at $190, and UBS at $220. All but a couple of those price targets are well higher than the $200 a share I paid on December 9th to buy 3 shares of General Dynamics for the Income Builder portfolio. This channel's co-founder, Greg Patrick, allocates $1,000 twice a month for me to make buys on his behalf, and I divided the remainder of that amount between 2 other IBP positions, biopharmaceutical company Amgen and utility Alliant Energy. Both companies are leaders in their industries and get A- credit ratings from Standard & Poor's. We initiated the Alliant position last March, and it is a total return of about 18% since then. As for Amgen, it was the portfolio's very first purchase all the way back in January 2018, and this is the 5th time we bought some shares of it. On December 3rd, the company gave shareholders a nice 10.2% dividend raise, lifting its yield to 3.7%. Alliant yields 2.8% and is due to increase its dividend early next year. Early indications are the raise will be about 6%, which is good for a utility. Amgen's stock price has been beaten down lately, and it looks like a pretty good value here. Alliant looks to be about fairly valued. After these latest buys of General Dynamics, Amgen, and Alliant, those 3 positions are projected to contribute about $250 towards the IBP's income stream over the next year. If you want to learn more about the Income Builder portfolio, please check out the link in the description. Okay, that's all for today, folks. Again, if you value our content, please give us a thumbs up, subscribe, and ring that notification bell. Take it easy, everybody. Back at you soon.